Welcome to today's lesson of the day. You're going to get the real deal on something that's always important. We sort of talked about limiting losses before, but like taking profit, there's no such thing as a bad way to make a winning trade. If you gain in a trade, P&L goes up, then you've had a success. But there's always a way to refine your exit points so that you can try to maximize it as you go along. And I want to say this from the beginning. This is a process for all traders, and it has to fit within your own trading style. We went over in a previous video that you can check out like what that trading style might be, find something that suits yourself. What kind of a trader are you? Scalp trading? Are you intraday swing trading? Are you someone that likes to hold for the bigger moves, or are you somebody that wants to trade within a defined range? So you've got to set things up. Are you a technical trader? If you're highly technical, you've got to understand reasons in technical, reasons out technical. So it always starts from getting those definitions. So first things first, what type of a trade are you in, and can you define some expectations off of it? So I'm going to give you an example of a trade here that I actually took this morning, and it's more of a range-bound idea. So let me go to a 15-minute to really exemplify this point. If my thesis for getting into the trade on a stock like Intel here is there is a defined top right around $43.50 the last few days, and a defined bottom, right around 42, call it 60, so 43.5 to about 42.5, roughly speaking. You've had a defined range that it's been sitting in. If this is the reason for taking the trade, answer here would be yes, then my expectations are going to be defined by what it has done before. So if you get the short every single day, if you've gotten the short early, it is retraced at least toward the bottom, and then a couple of lower highs. You've gotten down around that 42.5, with one exception at 42.8 that happened the day before. So if you notice, I'm getting short underneath the high, but making sure that I'm holding some shares, might take some out for 1-to-1 scalps and 2-to-1, but then holding shares for that bottom, for it to get to that low. So you might be taking a piece out, but if you're too aggressive in the first 15, 20 cents of a 50-cent range, when the market has told you, if it rejects here, it's getting all the way to the bottom eventually, then I've got to hold something for that bottom. Now, in a range-bound trade, it's a little bit easier to see when you are breaking into a new range. Let's just say here, had it gone to the upside and was breaking out this top, then you'd have a break outside of the range, and you don't have clear defined levels. You've got a gigantic gap to be filled on the upside. So the approach for me, had this been a breakout long above 43.50, is I think you could say, oh, well, the gap fills in about 44.5, so there's $1 of potential upside in that trade. Breakout trades, when you consolidate, can be a little bit more explosive, but it's not as simple as I'm going to hold everything for $1. I don't think that's a reasonable approach. Why? Because it spent 3 days. If you count today, it's counted 4 days inside of this range. So what I then do is look at the previous breakdown from here, 44.4, into what was the support, that $1, and essentially chop it into quartiles. Because there is no perfect way to fill in that gap. It could go halfway, it could go all the way, but I want to make sure that I'm locking in profit so when it goes that first quarter and then goes that half, which remember, it's been a tighter range down in here, I'm going to be taking profit out on the way up. Now, once you've done that, and I call it scratching the itch, you can start to refine using potentially other technical indicators out there. When you don't have levels to work off of, you are trying to refine your strategy over and over again. Now, the beauty of trading is you might end up having some key price levels to work off of ultimately. I purposefully did not zoom this one out so that you couldn't see what we had lying here. You had a close at 43.70. You had a lower high in that gap before, in this same range, at 44.10. And then you had another double top close at 44.5. So in my style of trade, if I had nothing to go off of, you might go into the quartiles by random. Otherwise, I want to look to hold to the next gap in key level. I'd like to play off support and resistance, so I play the ranges, hold till the next key level, cover. if it does any kind of a slowdown in that range. When it gets to the next key level, cover if it does any slowdown within that range, and then sort of work the trade in that fashion. The other thing that I try to do is, if I've defined a counter trend trade, and sometimes I'll show you ones that work and ones that don't, and I'm going to show you Unity here, which was good idea, but didn't end up winning for me, is what it is. We had the short, it came off the top. When we say define the trade, if I'm going counter trend, I'm never expecting personally to hit the gigantic home run. So one of the trades in my toolbox is a mean reversion short at a key price level. If it's against the trend, my target is opening range bottom or VWAP. To give an example of what that looks like for taking profit, zoom back out in the chart. There is the 31 potential support from before. Stock is trending up. It curls off of that 31 area. I'm looking for the short off of that high, and I want the opening range bottom or VWAP. So the opening range bottom is your breakout price here at 29.50. And then VWAP was just sitting right around, at the time it was sitting a little bit higher than that 29.50. But if it's counter trend trading, I always have a hard target, understanding that it is going higher. So when shorting at 31, I'm not thinking it's going all the way down to 28. I want to be taking profit. If I'm risking 40, 50 cents, I want to make sure I can get that move down to 29.5. It happens to be 3-to-1, but I'm getting shares out at 1-to-1, 2-to-1, and into that 3-to-1 because I've got myself a defined out technically. If you are using technicals to get in, you want to use technicals to take profits. There are other examples of this where I think you, generally speaking, want to have something on board for the home run. An example of that would be a squeeze name like Carvana. Obviously, this is an 18% move up. It's far outpacing most other moves. On the daily chart, I always zoom out, and if you're long this stock today, it's already broken away from this level on the daily at 62, 63. It's about $20 higher from there. Today's move is another breakout of $76 to the top. So let's say you're in the 76 breakout to the long side. What would I be looking for some profits? Well, when it was breaking away from 62, what was the range? There's your 66, there's your 76, there's your 66, there's your 76. Recurring theme here, that's about $10 to the upside. So yes, if it's breaking out 76, am I covering something in front of 80? Almost always. Would I be covering something in front of 84? Almost always. You had a consolidation at 74, 1-to-1 is the first $2, 2-to-1 is the next two. That said, once it's broken 80, the last hold to me is till $86 because that is the expected range off of that break. So it's all about what are your reasons for getting in or out. I like to use the actual ranges that the stock has shown me before because that's often the reason I'm getting into a trade. If you use Fibonacci's to get in, then use Fibonacci's as your exit points. If you use moving averages, then you want to back test, okay, well, when it bounces off this moving average, what percentage of the average true range might it have gone through? Those are the types of things you want to keep in mind there. And then one last thing for you. You might be trading using some kind of a leading indicator. If that is the case, this is a wrinkle that sometimes I'll put in there when talking about big cap tech names. If I have a reason such as I like the short on NVIDIA and it's trending in one direction or the other, but I like the short if the market can't get above X or Y, and today it happened to be the 18,000 level. If I see too much strength in what I'm using as leading indicator, it might be SOX, it can be a million different other things. If I see too much strength in my leading indicator, that can be a reason to take profit on its own. Whether or not the stock has gotten to my target or not, if my reason for getting in has confluence with either an ETF that tracks with the stock I'm trading or the overall market, which is loosely following it, maybe it could be Bitcoin and Mara, whatever that might be, I might simply be taking profit because I'm expecting a reversal due to that leading indicator giving me the indication. So you've got to define that trade. If part of the reason for getting in is a leading indicator, then that needs to be something you listen to on the way out. If you're trading within a defined range, then you want to listen to the key prices within that range and take profit, not hoping it goes further, but understanding that, okay, it's got to that first break level, then I need to get something out. But I should be holding something for the entirety of the range while the trend is working. As always, make sure you back test and fit your profits and fit your targets to your style of trading. If you're not somebody that sits there and holds for the home runs successfully, then you work towards that. But do what works for you is the best advice that any trader can ever get. There's no such thing as a wrong way to take profits, but fitting it to your style of trade is always going to lead to better trades for you. That's the real deal in your lesson of the day. It's always good when to take profits, but you can still get better.